Howdy, Jacob here. Today we're looking at AptarGroup in the containers and packaging industry. Almost 10 billion market cap, a little over 10 billion enterprise value. Again, always cool to see companies I don't think I've ever heard of that are this large. Growth is relatively small, probably looking at 2 to 4% CAGR over the last 10 years. Operating margin and gross margin are actually up though, so that's positive. Return on invested capital down a little bit, but still upper single digits. So probably right in line with their weighted average cost of capital. Increasing the dividend every year, pretty light, but still increasing it. Earnings per share a bit higher as well. Balance sheet shows 224 million cash on hand, 458 million short-term debt, 681 million long-term debt. So they're going to have to refinance that very shortly. You don't necessarily want a lot of debt to come due short. You want to pay it off and then refinance it if you can't. And I mean, we'll see what their leverage ratio is here. So about $1 billion and free cash flow. This other line is their capital expenditures. I don't know why keeps messing up, but the 5-year average, we're probably looking at about 200 million. So it is their short-term and long-term debt combined for about 5-year average free cash flow. And that short-term debt, you want them to refinance that, because if debt comes due and it's not refinanced, it's not paid off, you're going to have to sell some assets. And I mean, good news is they have assets to sell, but bad news, they sell that, bam, huge detriment to sales, and then it can cause a trickling effect that's not so good. And so the use of cash we see is a little bit on the acquisition side, a little bit of share purchases, debt pay down, and then this dividend of 106 million is only about 1%. And from the whole 5-year average free cash flow, it's probably a little bit less than 50%. So they are spending a lot on this dividend. I would probably, just because they'll increase it, I'll increase it 1%, just to say that they increase it every year. But I don't want them to be increasing it very much. It's already a good amount of their free cash flow, and they need to focus on that debt reduction and debt refinance. I think their leverage ratio is fine, so they should be fine with refinancing this debt. But you definitely don't want it to be coming down to the wire to where debt is due in October. They still have 400 million due, and they haven't told you as a shareholder what they're doing yet. That's going to be a problem with me, and should be for you as a shareholder as well. So let's start making some assumptions here. Revenue growth side, probably a little bit above inflation. Let's do market average. And then for margins, very similar. Maybe let's do 7.57. And for share repurchases, just offset stock-based compensation, so 0. This is assuming that about 50% of them, 40 to 50% of their free cash flow is going towards a dividend, and then maybe let's say 20% goes to share repurchases. It's going to offset their stock-based compensation. The remaining 30 to 35% is going towards reinvestment, making acquisitions, paying down that debt. And again, they do have a good amount of debt here, so this will leave a bit of money to reduce that debt, so that preferably at the end of 7 years, it's more like 2 to 2.5 times their 5-year average free cash flow instead of 5. But anyways, we get to a price that needs to fall quite a hefty amount before you get the return I'm looking for here. This is interesting company, not super sexy, but not a bad company, just nowhere near the price at this moment that I'd be considering doing more research on. So hope you enjoy the video. Have a great day.